Hello and welcome to the Laddercast. My name's Sorsha Porter and I'm a real estate agent based in Portland, Oregon.
I am Shannon McAllister, a mortgage lender, also in Portland, but I can do mortgages anywhere, so that's pretty cool.
And today we are talking about interest rates. Very hot button topic for October 2022. In case you're listening to this far in the future, it is October 2022.
We're going to reminisce on this period of time. That's a strange point in history about, do you remember what happened in October 2022, where you were?
I mean, let's be honest, this has been a really wild year for real estate in our industry. We went from the era of the golden real estate age where people could put houses on the internet and they were sold in 24 hours to
multiple offers, over asking.
To now where houses are sitting for 30 to 45 days before they get a single offer. And a lot of it is driven by people's fear of interest rates. So we felt it was important to talk about that. First of all, Shannon, I'm going to have you explain this part because this is what you do.
Okay.
Why are interest rates what they are? How do they get here? And what drives them? Because I think a lot of people are aware that interest rates are higher, but they don't really know why.
Why? I think, yes, I will explain that. I think, I might be projecting, but I think that a lot of people think that interest rates are where they are because they see the Fed keeps increasing rates. The Fed's increasing the rate. They're pushing mortgage rates higher. That's not quite the case. Actually, the Fed increasing the rate that they are increasing, which is the Fed funds rate or the prime rate, which is not the same as mortgage rates, is actually the Fed trying to do bigger moves where the overall effect would be mortgage rates come down. So the Fed funds rate, that is the rate that banks can borrow from each other on an overnight basis. Banks can't possibly keep enough cash in their vaults to cover the amount of debts and cash and things they need to make the bank run. And they do swaps between banks overnight to keep their balance sheets organized and make the world go round. And so the rate at which they can borrow from each other is the Fed funds rate, which is the prime rate, which is the base of any adjustable rate, anything, right?
But the truth is lenders can set their rate at whatever they want. They just use this as a guidepost. Right?
No. So the Fed funds rate really has nothing to do with mortgage rates.
Ah, okay. I see what you're saying.
Yeah, the Fed funds rate is just like an interbanking situation between big banks and the amount of cash it takes them to operate on a daily basis. What it does, though, is it has a bigger effect on the market as a whole. When that interest rate goes up, it costs more money for banks to do business. It costs more money for everybody to do business. And that has a trickle-down effect through the market, right?
So the Fed funds rate is the stone you dropped into the bucket. The ripple effect is what we're seeing.
Yes. So let's be clear about that. Make sure I'm speaking clearly as not to cause more confusion.
Okay.
The Fed funds rate is the overnight borrowing rate between banks. Okay? Not the same as mortgage rates. Mortgage rates are largely affected by inflation. Inflation and mortgage rates are basically directly correlated. Inflation rises, mortgage interest rates are going to rise. Inflation comes down, mortgage interest rates are going to come down. Has been the historical pattern. Anyway, no guarantees into the future about anything, but the historical pattern over the last 50 years, every time we go through one of these patterns of high inflation, mortgage rates rise, and when inflation comes down, mortgage rates will come back down. And so what the Fed is doing by raising that prime rate is they are trying to curb inflation. By raising the prime rate, that is their effort to help reduce inflation.
And the inflation that we've seen over the last several years is sort of what's driven the crazy market that we had through the pandemic, right? That's what caused those multiple offer, high value over asking situation is
because inflation was low during those periods. And so it was cheaper to buy a home. The interest rates were low. Inflation was low. Interest rates were low. Costs of living were lower. It didn't cost as much to buy homes. And so you could offer more money and still be okay.
Yeah.
Right.
And that's why, people have been like, oh, it's just a really hard market to buy. That was a direct effect of that, is that the money was cheaper. So prices went up. Yeah. So now money's more expensive.
And prices are coming down. They work together. So let's.
Going back to.
Have I made that sufficiently muddy?
I think you made it fairly clear, actually. Okay. Now, when we're talking about how how interest rates are now, a lot of things that I hear is interest rates are really bad right now. But are they actually bad, or are they just higher compared to what they've been?
It's relative compared to how old you are, the houses you've bought in the past, what your experience has been, and how much news you watch.
Cool. Break that down for us.
All right. It's been a real cool time in my life. I've been doing mortgages for 16 years, maybe 17. Can't remember. Something in those neighborhoods. In that period of time, I've never done mortgages in the 2s. I did the last couple of years, and that was really cool. But they are very seldom that rock bottom low. And so that's not a place where you can base anything going forward with. You can't expect to buy a house at this price and have a payment of this price. If you're in your head, you're like, well, rates were low in the 2s. I want to get that. That was a one-time blip in the universe that was real cool, but that's not the average. That's not historically what has happened. We were trying to find some numbers quick to sound smart and official but it's also hard to quote numbers from reliable sources. And so we don't want to give misinformation about sources of things.
And so essentially what we did is we looked at a couple of different sources, and it looked like the average over the last 20 years, 30 years was roughly.
It's it depends. There's all sorts of factors about it, but
we're saying very roughly.
6 to 8% on average for the last 30, 40 years for interest rates is a reasonable range that you can expect an interest rate for a mortgage to be. If you get lower, great. If you get higher, bummer. But it's a reflection of that period of time right then.
And what I think is interesting is when people talk about mortgage rates being so high, it's still pretty cheap money. We're talking about borrowing hundreds of thousands of dollars for 6 to 8%. You're not going to find a credit card that'll do that. Nobody's going to give you money like that to play the stock market. Nobody's going to lend you money like that on most loans. But we've applied, because of how privileged we've been in the last 5 years, we've applied this idea that money's really expensive right now, when in truth, it's not. Look at any of your credit cards.
I did recently. I was doing some reorganization, and I'm all in the 20s.
Yeah, it's that's normal. That's normal for people with great credit.
I didn't like that one bit.
No, it's not super fun. I just pay the bill at the end of the month, and I ignore the credit card amount.
Take it.
But yeah, I mean, it's that's a normal amount to charge someone to borrow money, to take that risk. Yeah. Really, 6 to 8% is not that terrible. And
it could make that range so we were being super wide net here, whatever, call it 4 to 7%.
Yeah.
So whatever that range is, it's in that middle range. It's definitely not the 2s. Common is not the 3s. Those are anomalies that happen at that period of time. It's not super far out of the realm of the average if you were to just smooth all this out over the last 30 or 40 years.
Yeah.
In the 80s, they were in the double digits for a long period of time. Late 70s into the 80s, they were 10, 15%. For a long stretch of time. Let me find that quick chart here. I know you can't see that chart, but it is helpful that I can explain it better. That I think it's a good close to 7, 8 years in the 80s that rates were double digits.
And you know what? People still bought homes and people still sold homes. The market doesn't stop just because interest rates are higher at a given moment. And the thing that I think a lot of people because people are going to be like, well, I don't care about the history. I care how this affects me now.
Perfect. That's the conversation we should be having.
Yeah.
Right?
I think that the question is, I think it's important for you to understand the history, and I think it's important that that this isn't really that high.
Yeah. It's perspective, right? We're trying to give you some perspective. So I'm going to read off this little chart. Again, haven't validated the accuracy of these things, but it paints a picture roughly of the point we're trying to illustrate, which is 70s, 1971 to 1979, average interest rates roughly 8.9%. The 80s, 80 to 89, 12.7. The 90s, 8.1. 2000 to 2009, 6.3. That's the period in which I've done lots of loans. I can attest. We were 5s, 6s, sometimes in the 4s. All very, very common, right? Yeah. And same with the 2010 to 2019, 4.1. I can attest to that also. That is the range that I was doing mortgages in during those years.
Yeah, I think I was at at 4.1 for my first mortgage, which was in that period of time.
Yeah, so you see these swings. That might help put some perspective around this. And so the whole point of the conversation is, it is what it is at the time that it is. And we do the math to make sure that you are making the right decision for your goals today and going forward. And if it fits and it's right, that's what we focus on.
Yeah, I think that people are going to have to get away from this idea that things are going to come back to 2%.
Oh, yeah, no.
As you can see, there's only been one very short period in history in the last, 30 plus 40 years that interest rates have been in the 2s. And I don't think there's been a time in history prior to that where interest rates were in the 2s either, from what I've seen on any chart.
I'd have to look real
we'd have to verify that.
Look real deep,
don't hold our feet to the fire on that. But I'm pretty confident that we have never seen interest rates as low as we did in the last 3 years. And you know what? We're probably not going to see them again. You need to let go of that idea.
Yeah.
You need to stop waiting for it to come back. It's not coming back in all likelihood.
So what do we do?
Do?
All right, we've accepted our fate and our reality. Interest rates for most average people right now are in the 7s. My first house, I got 7.625. So we're right about there. We're not quite there, but we're darn close. So cool. All right, this is my reality. What do I do?
Well, my answer is, if you need to buy a house, you buy a house. If you need to sell a house, you sell a house. And you are going to have to work really hard with your realtor and make sure your realtor knows what they're doing to price it appropriately so that you will get what you need out of it to move your needle on your financial plan.
So talk to me, please, about house prices and things happening. We kind of hit on it at the beginning, and then I flew right past it because I'm a fast talker and I was trying to get other places. But as interest rates increase, what is that doing to housing prices?
It's going to suppress them. They're going to go down.
Is that bad?
It's not bad. It's not bad unless you are upside down on your house. There are going to be a lot of people right now who purchased in the last 2 years at the inflated prices that we've had to buy those ultra low interest rates, who are going to, in the next couple of years, lose money on their mortgages, on their homes. Their homes that appraised in the 6s are probably going to, if they were to have them appraise in the 5s. Maybe even the 4s, because they're going to have to adjust for the cost of a mortgage. Overall, though, over the course of time, properties gain in value. You have to stop looking, times like this are the times to look at homes as a long-term investment and not a short-term one. I think a lot of people apply different rules to buying houses than the rest of investment, when really this is just a tangible investment instead of a conceptual one.
But it's also the most personal. It's our space. It's where we live. We're most tied to it and most invested in it than stocks feel theoretical, sort of, right? It's not a thing that I have. It's not a tangible that I'm taking care of every day. And I'm vacuuming the floor on, right? Yeah, and with that comes, if you need to buy a home, then you need to buy a home. You have to stop looking at it as, I'm going to wait for the crash. I'm going to wait for interest rates. We talk a lot about this in our show, that hope is not a strategy for financial investment. And I heard a new one this week, and I've forgotten. It went right out of my head. I'm going to think about it, and I'm going to tell y'all when I think of it later. It was the follow-up to Hope is Not a Strategy, and I was like, ooh, that was really good. But yeah, we always say, I'm interested to hear what it is. It's going to come to her in 20 minutes. Yep. But hope isn't a strategy. And so we need to look, what buyers are going to have to do is, first of all, it's a great buyer's market. Let me just say that. Last year, I had a lot of people who were backed out of buying because it was so competitive and they were too stressed about the multiple offer situation and the cost of everything to get out on the market. We are officially out of that phase. It is a buyer's market. I just negotiated $30,000 in concessions up front on a purchase because my client could get it. Let's give some detail about that in case people don't know what concessions mean and how that works. Yes. Concessions mean basically, in this case, the seller
paid the closing costs and prepaids, which we've talked about in the first couple of episodes. If you don't know what those are, go back and listen. Goes over what the different parts of a transaction are and what they mean. But the seller paid closing costs, prepaids, and bought down some of my buyer's points to make the mortgage less expensive, which we'll get into in a little bit.
So this was amount of money that you offered X amount of money for the house.
Yep.
Plus, you asked the seller to contribute $30,000 towards these expenses that the buyer was going to incur.
Because the seller is getting a big chunk of money for selling their house. When we close, the seller is also going to give up that $30,000 to the buyer's lender to buy down their points. So they're basically saying, okay, you've offered me this much. I will accept. I will pay this much. I'm willing
to give up this much money of my profit in order to make this transaction happen.
And so those are the things that you need to expect as a seller right now, is that you're going to need to incentivize buyers with things like rate buy downs and things of that nature. But I want to focus mostly on the buying part right now and then get to what it is to basically mitigate the cost of your mortgage after that.
Okay.
Shannon, when we were talking about this before, you were asking, why should people buy now if the value of their home might go down?
Right. So why in the world would I buy a house now? And we're seeing prices, all right, in Portland, we are seeing prices decrease somewhat. And so knowing that they might continue to go down, why would I buy a house now knowing that I'm going to lose money in my investment?
The answer is it depends on your financial situation, whether or not you plan to hang on to the property, and what you're purchasing it for. One of the things that happens is when money gets more expensive to borrow, rents go up. Rent is going to go up. Next year, Portland has increased their rental cap to like 14 point something percent, almost 15%.
Which means landlords per year next year can increase rent nearly 15% legally.
With every renewal. So your rent's going to go up. Their costs are going up. They have inflation. They're hit by inflation too in other areas of their business operation, of their own things. So they're going to incur more costs, and they're going to push those to renters. So first of all, your rent's going up. And it's a matter of, do you want to keep paying someone else's mortgage and never see that money again? Or do you want to be paying towards something that in the next 10 years will most likely be more valuable than it is right now? Because that's the game that we're playing with. That is the housing game. Everyone needs a place to live. That's the other thing. You need a place to live regardless. Do you want to be paying someone else's mortgage, or do you want to be paying your own?
You're paying someone else's mortgage, as their expenses increase, your costs are going to increase.
Yep. And that's happening right now. You're seeing it at the grocery store. You're seeing it with your favorite brands and consumers. Everybody's costs are going up.
We should do an episode about how to hack that business. I've found several this week that I'm pretty proud of.
We should definitely do that. I agree. But that's the reality. Your rent is going up. Do you want to keep paying for an increased rent in the same place that you're living right now? So that's the question you have to ask yourself. The other question you have to ask yourself is, do you want to continue to live in a place with restrictions that you have no control over? Is where you're living where you want to be? Do you have a yard? Do you have a dog? Do you want a pet? Can you have a pet? Do you want to be able to work on your bike or your car in the driveway? Most apartment complexes won't let you do that in their parking lot. Are you
paying for extra storage because your items don't fit in your apartment or your home?
And are you ultimately at the whim of someone else for your biggest fixed cost in your life? Because if all of the answers to those questions are yes, and you have the finances to handle a mortgage payment right now, then you might want to consider buying.
And part 2 of that is, when you buy a home, all of the variability goes away. Of the rent increases, you now can choose what your payment is going to be and know what it is going forward, aside from taxes and insurance, which do increase, which at a
fairly minimal rate.
They do. When I hear people talk about, this is my payment for the next 30 years, it's never prefaced or followed up with, taxes and insurance do increase every year. Thus, your payment will increase a little bit, but your actual mortgage cost will stay the same. And is the peace of mind and security of having a fixed housing payment during these times when There might be job decreases, things of this nature, and other costs in life are increasing. Is the comfort and security of a fixed payment worth having during this time when you might experience a little bit of a decline in your investment?
Yeah.
During these strange times.
Exactly. And I think that is something that shouldn't be ignored. Now, for some people, if you're someone who's like, maybe I'll buy something and sell it in 2 years, if you came to me and were like, I don't know, what do you think? I would tell you, probably don't do it right now. Probably don't buy something and sell it in 2 years.
Yeah.
You need to know that it usually takes about 3 years on average for interest rates and everything to adjust back down because we're technically in recession, right? After a recession, usually it's a 3-year period, historically, from that point to where it starts to go back down. But, where was I going with this? But what I want to like focus on is that if you need a place to buy and you want to lock in your expenses.
Right, don't sell. If you're just like trying to sell something in the next couple of years, you got some money to play with, you're like, I should buy a house and I'm going to leave it in 2 years. Like, we should do some math about that, about costs and time value of money and recouping your recurring costs during that period of time. And is that the right thing to do? Correct. But if you are looking for a home to buy, when you are ready, when you feel you are ready, when you are feeling that it is something on your brain, it is the time to consider it.
Yep. If you are financially ready, if you are emotionally ready, if you are sick of renting, then you should buy. This is a great time to buy because I don't think we're going to see a price depression like this I don't think this is a very long period of time. All the economists that we listen to are saying that this is really not going to, they're saying 6 months to another year and a half is what everybody's I've seen says. And if in the next 6 months to a year and a half, prices are down by 10 to 15%, that's pretty dang significant. That's not competing for that cute house in the cute neighborhood that you want to be in. So it's, in my opinion, a great time to buy as long as you can financially handle the payment and weather out the
payment now when rates are higher than what you would like them to be. And what about if I have to sell my house?
If you have to sell your house, then you need to be realistic about what the market looks like. Okay. Right now, the houses that I'm seeing sell quickly, and they're still happening. There's still places in, at least here, where the neighborhood is always hot because the inventory there is low and the desirability is high. That is normal. That's areas like Ladd's Addition, Irvington, Alberta Arts. Houses are still going pretty quick in these areas. But what I'm seeing overall is that houses that are dialed and done, and when you hear realtors say that, that means the paint is all refreshed. It's nice and refreshed. It's nice and tidy. It's been staged. An effort has been made to present the house in a show home type of way. The yard's cleaned up. Major maintenance has been maintained. This isn't the time where your house needs a roof replacement and you can just like forget about that and someone will buy it. It's going to sit in that case. Sellers are going to have to be on their game. Consider it like any consumer product. Houses, like any consumer product, are affected by desirability. And when you have a lot more houses on the market with less buyers competing for them, they have more choice. So your job as the seller is to make your house the best choice for your buyer.
Which I feel, and my feelings don't matter, it's just my thoughts, that should be the case no matter what. Even if you are in a crazy, hot seller's market where you have multiple offers coming in, you are just you should still be doing these things anyway. Don't just throw your dumpy house up in a dumpy manner. Agreed. Because you're like, I can have as many buyers as I want. Like, put some effort into it, people.
Agreed. And I fully agree with that statement. But there are sometimes people that I work with who they have 4 kids and busy schedules, and the idea of getting a house ready for sale just to get it cleaned up and keep it clean on a daily basis for showings is overwhelming for them. For those people, you need to be aware of the things that you need to do to make your house saleable.
It's time for an honest talk with your realtor about expectations and requirements and what it's going to take to get what you need and to do what you need to do.
Yeah. And I recently heard, I was listening to a real estate podcast, can't remember the name, which isn't very helpful for you guys. But from what I'm hearing in the Pacific Northwest, houses are starting to sell for between 5 and 15% less than list.
Okay.
So we're 5 to 15% down.
Is the list realistic? Like, should they have just been priced the 5% less anyway?
We can't know that. That's the other thing is what a lot of people don't realize is realtors and their clients price the home. Appraisers appraise it. The appraisal value is the actual value of the house. That's what sets the value.
As of that person's opinion of that day. We've had that talk.
Yeah, we've talked about appraisals. But the appraisal value is like what the bank is going to lend on. But you can set your house price at whatever you want. And what I'm seeing a mistake a lot of people are making right now is they're like, well, let's price it at what I want it to get for it. And then
hope for luck.
And then hope for someone who's going to come along and be an idiot and not look at the comparables in the market. Because I think that a mistake a lot of people make is they think that pricing a house is like pricing a car on Craigslist. Someone will come along and offer me 20% less and I'll be happy with that price. But what actually ends up happening is they just go buy another house and your house sits for 2 months. And you're you're paying a mortgage you didn't really want to pay, or you're not able to get into the house that you want to get into, or you're paying 2 mortgages if you've moved out of your house in order to sell it. So
let's be realistic.
You need to be realistic.
Let's be honest.
And you need to price your house. Basically, you need to make it the most competitive price that you can while still making the money you need to make.
Okay.
I am, for the first time since like 2014, 2015, seeing more than like 25 houses priced under $400,000 in the Portland metro area. I think I just looked it up because like Redfin will automatically calculate how many single family homes are currently for sale under $400K. Right now it's like at 239.
That makes my heart feel good.
It means that normal people are going to be able to buy a home, because you know what this decreased price means? Less cash up front.
Yeah.
You have lower down payment. People with, 10 to 15 grand are going to be able to get into a house, because not only is your down payment going to be lower, but your realtor has more negotiating power. Your realtor should be able to, in many situations, get you closing costs, get you prepaids, get you things that like 6 months ago were not
Sure.
things that people could get.
Things to help you get in the house. In my head, you say this, and we're talking about where we live, and it's so dependent on your area.
Oh gosh, yeah.
You say 400, and I think starter homes are back, people.
Yeah.
Like, let's get people into starter homes that are affordable, and even with higher rates. We're going to talk about the affordability issue. What is your payment at these lower prices, and can you do it, and is that the right thing to do? And if it is, fantastic.
Yeah. And I think it's not like you compare us to places like we're still the cheapest metropolitan market on the West Coast.
Oh yeah.
We're cheaper than San Diego, we're cheaper than LA, we're cheaper than what? Seattle, we're cheaper than San Francisco by a lot.
Yeah.
And if you're listening in a suburban area outside of Chicago, Illinois, your prices are going to be really different.
Yeah.
And your market's going to be different. But
we can talk about that though. Because it's all relative to you and where you live and what's affordable for you and what makes sense for you. It's all relative to who you are. We just happen to be sitting here.
Yeah, so we can only speak to this. But yeah, starter homes are back. The ability to get on the property ladder is more available to you than it has been in like a decade.
That's awesome.
Which is really cool. If you've been dreaming of buying your first home, like this is a great time to do it, because you're not going to have to compete with a bunch of people.
Right.
Which is pretty dang cool.
That's pretty dang cool. All right. So, but still we're still buying the starter home.
Yeah.
Great. Starter homes are back. That's great. At least price points for roughly starter homes.
Or starter investments too.
Yeah. Cool. All right. But rates are still kind of high. Even if I've accepted my reality, it still feels high, and it's making my payment higher than I want.
Yeah, so what do you do about that, Shannon? What are things we can do? Right. What are things that we can prioritize in order to help people lower their payments, basically?
Okay. I got lots of things here. We ready?
We're ready.
Got your pencil out? All right. My first is always take a look at yourself first, because your house payment is one thing, but what other expenses do you have going on in your life that you should have maybe been a little more on top of or could reorganize to help save cash every month? When times are great and money's rolling in and money's cheap, we tend to just kind of rack some things up, right? Maybe now's the time to buckle down and do a little self-reflection and get everything else in your house organized to reduce other expenses as best you can.
Yeah.
That's one thing. That's always the place to start.
Dial in your finances. This is the time to do it.
This is the time. Remind me later, we'll talk about your meeting at your office where there were some suggestions about what that one woman did to do those things.
We had someone suggest making some credit alterations and setting herself
we're
up
here.
for
Let's just do it now.
Success.
We're here now. So organize your finances in a way that helps. This person in particular, you told me, maximized credit card points, right?
Yeah, she ended up signing up for several business credit cards that had great point systems. And even though the fees for the cards were higher, the amount of points she got was so high that the month where her business wasn't making any money because of the recession, she was able to pay all of her cards with credit card points because she had just saved them up. That's a really smart way to leverage something that is free. The points are free. You were going to spend that money anyways. You may as well get paid back for it.
Yeah.
So that's pretty cool. And it way outweighed the like $50 a year fee that those cars had.
So those are things that I've recently rearranged some things to maximize points. My points gathering is for the intention of using them to travel. I don't want to pay for travel, right? I want someone else to pay for that. So there's ways to do that. That's organizing your life outside of your mortgage. Like get your life under control outside of the mortgage to help there, right?
Yeah.
All right. Do that first. Actual mortgage things. How can I get my mortgage payment lower? Let's take a look at your insurance.
Yep.
Now, I don't often advocate for a higher deductible because if you need your insurance, you have to pay the deductible before it will kick in and do what you need it to do.
For those of you who don't know what a deductible is, that is the amount that you must contribute before the insurance will pay out for a loss. So let's say your fence blows over in a storm, wind is covered under your policy. By the way, I used to be an insurance agent. And your deductible is $1,500. Your fence is going to cost $4,000 to replace. Basically, you pay $1,500 to the contractor and they pay the difference, or they give you a check for the difference. And so you only had to pay $1,500 to replace this fence that without insurance would have cost you $4,000.
Right. It's the amount of money you have to pay before your insurance kicks in.
But if you want, you can take a higher deductible.
You can. If you understand and know what you're doing, there's two things about it. Now is the time to review everything. Review your insurance policy. Maybe you need to do some shopping that you could get the same coverages and same deductible at a different rate at a different company.
Yep.
Okay. Bundle cars, do all those things. And then look at your deductible and make a decision about what you're willing to cover or not. Do you have the savings to pay a higher deductible to have a lower monthly premium? And that's what the part we missed.
Yeah.
A higher deductible generally equals a lower monthly premium.
Correct.
So,
and it can be pretty significant, but you need to know that like if you have an emergency,
if your roof falls in, you need to be able to come up with the cash to cover that deductible to get your roof on.
Yeah.
So, but most people's are in the realm of $500 to $1,000.
Yeah.
So,
and it depends on the type of loan you have. Some loans have caps on what your deductible can be.
They do. They're generally pretty high. They're kind of alarmingly high.
Oh, cool.
Yeah. So just consider it. Take a look at those things, right? Make sure that if you are eligible, you are taking advantage of any tax savings in your area. For example, in parts of Portland, if you are a veteran, you get a partial tax exemption that lowers your property taxes.
Which is pretty cool because our property taxes are kind of high.
Yeah. In Washington State, there is a senior citizens tax deferral. There's a low income tax deferral.
You can also look at different parts of your area. In Portland, certain neighborhoods have lower taxes because they're historically they've been set up in trusts and historic tax break systems.
Yeah.
For example, there's a lot of areas in St. John's where taxes are like 30 to 50% less than the rest of the city.
Yes.
Versus the west side where they're like 20 to 25% more.
Right. So if you're shopping for a home, the areas you're considering shopping in will greatly affect your payment according to what the taxes are in the neighborhoods you're considering.
Yeah.
So we run those numbers.
And when we're talking about higher payment, we're looking at, Shannon and I, when we talk about payment, we're always talking about your principal, interest, taxes, and insurance together.
Oh yeah, the whole
thing, because that's how most people pay their mortgage.
That's money out of your pocket every month to pay for your house. So it's the whole thing. And these are all components of what make up your mortgage payment, right? Yeah. So let's look at each component and see what can be done.
Yeah.
And frankly, if you already own a home, you can still adjust your insurance. You can still go look for tax savings and adjust those things if you are already in a mortgage and already have a home. Do these things now to help your payment now.
Yeah.
Right?
If someone in your household has a small business that they run out of your home, make sure you're talking to your accountant about what things you can write off to reduce your costs overall.
Yeah. So if you're out looking for a home, if you're a home buyer, and we're still talking about what are we going to do to get an affordable monthly payment, we're going to do those things. But here's also what we're going to do. We're going to look at different mortgage insurance options. On any mortgage, anytime you put less than 20% down, you pay monthly mortgage insurance.
And a lot of people hate it, and it gets a bad rap, but don't hate on mortgage insurance. No. It allows you to get into a house for less money.
It does. It's not bad. It's great. But if you're doing certain types of mortgages, if you're doing conventional mortgages, you have some options. If you have some extra cash, you can buy out that mortgage insurance altogether. You can pay a lump sum of cash and eliminate the monthly payment.
Which is pretty nifty.
Or you can do halvesies. Half of the cash up front and then half your monthly payment. There are adjustments you can make there if you have some dollars to play with.
Monthly mortgage insurance.
Oh, sorry, yes. Your monthly, yes. Not just your whole mortgage payment. We're not going to have that.
They can't do that for you, but mortgage insurance on my house I think is around $200 a month. Yes, I have mortgage insurance on my house. Mm-hmm. Most people do, and I mean half of that's significant. That's like a whole month of electrical.
Yeah. So there's things we can look at there. We can play the game of if we have some extra cash, or if you negotiate a seller credit to go towards your closing costs. Maybe we apply that towards adjusting your mortgage insurance to reduce the monthly payment.
And this is where it's really important for your realtor and your lender to have a close relationship and be able to get a hold of one another. That's another thing I want to emphasize is your ability to communicate with your lender and your realtor is going to be vitally important to your success in affording your payment in this next couple of years.
Sure, that's your team of people, right?
Because I have clients who you can choose whoever you want to work with.
What?
One of the reasons I often recommend Shannon is because she and I communicate. I know I can get a hold of her. I know I can ask her questions about what things cost and figure out the best way to save my client the most money.
Right, we put together scenarios when she's preparing an offer. We talk about the costs, the what ifs, what can I get? So she has all the numbers and figures and then can prepare the offer that they're going to make to be successful.
I think a lot of people look at at your mortgage and your lender as like a commodity that can be shopped for. And I don't think people realize how much the quality and ability of your mortgage lender to communicate with you and service your loan should play a factor in the loan that you go with.
Yeah, you get what you pay for.
You do. And I've had people choose Shannon over other lenders who were maybe cheaper on the overall, but Shannon picked up the phone and their lender wouldn't. So these are just things to consider when you're shopping mortgages, because a lot of people are going to start shopping mortgages more than ever before.
Oh yeah, it's going to get really, it's cutthroat, and mortgage professionals, as things maybe slow down a little bit and not everybody is crazy busy, they're going to start competing just to get the deal, right? So you're going to find yourselves in situations where you're going to shop and people are going to give you offers and they're going to try and earn your business.
But do not discount the ability to do not discount the customer service of your mortgage lender and your realtor in this time. Don't go for the cheapest person.
And their expertise and what they know, how long they've been doing it, all of the things, right? So, same as any professional you shop for anything for, right?
I just think that it's going to be really more critical now than it ever has been for you to do. It's not, houses aren't getting to the closing table as easily right now as they were. And that's a big factor. But you were saying other ways that we can, we talk about buy downs.
Yeah, all right, we can, yes, ways that we can affect our monthly mortgage payment to make us feel better. Taxes, insurance, mortgage insurance, discount points. Discount points are permanent discount points. You pay one lump sum of money up front as extra closing costs to buy your interest rate lower. We have to do the math. We have to see how much it's going to cost to buy the rate down, how much that's going to move your payment. Does it make sense? Is that the goodest and bestest use of your money? Right? When we have money to apply to places, we have closing costs, we have down payment, and now we're factoring potential discount points. Is that the best and right thing to do?
Who pays those discount points, Shannon?
It can be you, or it can be the seller if you can negotiate that.
This is something really key right now. We're in a time where we can negotiate these things. So your realtor's ability to negotiate for you is, again, more important than ever before.
Yeah.
Most of my clients, I'm able to get closing costs and prepaids for.
Yeah.
And discount
and
points.
Some discount points. And so we're going to do the math. We're going to see how much money it's going to take to buy your interest rate to X. We're going to calculate how long is it going to take you to recoup that cost. Are you going to be in the house long enough to recoup that cost? Does it make sense? Do we have the money? Where is it coming from? All right. That's a permanent interest rate buy down. If we figure that out and we make that happen, that applies to your interest rate permanently. I'm going to make up numbers, but if your interest rate was going to be 7 and you have enough money to buy it down to 6.75, 6.75 is your permanent interest rate on your 30-year fixed rate mortgage going forward.
Roughly, what does that translate to a month?
Couldn't tell you.
Good. Okay.
Depends on your loan amount, right? It depends on how much you're financing.
Okay.
So
sometimes I like to make Shannon do math on the spot, and sometimes she just won't.
No, I'm not going to get that wrong. Are you kidding me? Are you kidding? No. All right, so that's a permanent interest rate buy down. Back from the grave from 15 plus years ago are temporary interest rate buy downs. Right?
which are cool, particularly for those of you looking to buy investment properties.
Yeah. So, temporary interest rate buy downs. Again, I'm making up numbers, but bear with me here. If the interest rate available to you is going to be 7%, which rates are in the sevens, you can get the seller to buy your interest rate down temporarily for the first 2 years of your mortgage.
So instead of a 7%, it goes down to...
In the first year of your mortgage, it's called a 2-1 buy down. It's a 2-step program.
Yep.
The first year of your mortgage, your interest rate is 2% less. It would be 5%. In the second year of your mortgage, it goes down 1% to be 6%. And then in the third year, it adjusts to your final rate at 7 and is 7 going forward.
So you get to quote them what their 7% is, and then you can show them what their first year and their second year would be, which is amazing when you think about it. Because, like, most years we all get raises for our jobs, we get bonuses, we get our income typically goes up over time. So this gives you an opportunity to get into your home in the first 2 years, have lower costs than you would. That's not a thing that's been available until now.
Yeah, it just came back. We used to do them 15 years ago. They just came back this month and with a vengeance. Now, the trick of it is we're going to calculate the dollar amount it takes to make that happen. What is the actual dollar amount per month between 5% and 7% for that year? What is the dollar amount between 6% and 7% every month for that year? Sum those together. That's an actual dollar amount that the seller or the builder of your home, if you're buying a new build, has to pay. You, as the buyer, cannot pay the money to make that happen.
Which is important distinction. It means that you have to be able to negotiate that. And as a real estate agent, I can tell you that there is more value in getting those sorts, at least for most of my clients, in getting those buy downs than there is in you negotiating a lower price. It makes a bigger difference on your month to month to get rate buy downs than it does to get something $30,000 less or $40,000 less.
That's correct. So if you can keep expounding on that for just a second, I'm going to give you a real life example of how much money it is saving my clients who are closing on their house today using the 2-1 buy down. So, and I just got the blue spinning at death, so
that's okay.
Slow
That's okay. So what I'm talking about here is when one of the things that's really valuable right now, and that will be really valuable for your home purchase for those of you looking to buy, is your ability to negotiate these buy downs with your sellers and get them to pay for them. Not every house is going to be, it's not going to be possible with every house. It just isn't. There are still going to be houses and neighborhoods that are super desirable where you're going to be competing. But particularly for my first time buyers, where there's a lot more inventory of starter homes right now, you're going to be able to negotiate these things with the seller to pay for them. And one of the things that I've been going back and forth with a lot of my buyers on is, would you rather have a lower payment every month, or would you rather pay less for the house? When you're paying,
that's just a math calculation, right?
Yeah, and for the most people are like, well, I'd rather have a lower payment every month. And some people are like, no, I'd rather pay less for the house. It comes out to what's more important to you. $30,000 less in loan is like less than $100 a month difference in price, but a 2-1 buy down is like several $100s difference in price.
In the instance of my clients who are closing today, the difference in the first year is $637 per month.
That's insane. It's a no-brainer from the perspective of, well, would I rather have them pay $15,000 towards my buy down, or would I rather have $15,000 off the top of the price? So you're really going to have to be choosy about what things you negotiate, because sellers are having a hard time swallowing the fact that it's no longer a seller's market. And so I think this comes to when you negotiate purchase and sale of houses, you can only negotiate what the other party is willing to put up with. And you need to be selective about the things you ask for, because even though, yes, it's a buyer's market, people are only willing to be pushed so far. And when it pencils out to $600 a month less,
that's enormous.
That's enormous. That's a car payment. That's huge.
It's huge. Now, here's also what I want to stress. Some logistics regarding that. From a mortgage perspective, you still have to qualify at the higher payment with the $600 more. Whatever, if your rate is going to be 7 in the end, you have to be able to afford that payment and that rate now. We are not going to let you
important call out. So it doesn't mean that this is going to help you qualify. It's going to help your payment be less.
It's just a bonus. You are going to have to qualify at the higher payment, because we need to know that when the payment adjusts to the final rate, you can make that payment, right? I would never put you in a home that you cannot afford.
That's not nice.
No, it's not kind. It's not nice. And don't be house poor. The intention and the hope, and again, that saying didn't come to me. I'm going to have to think real hard about it. The alternative to hope is not a strategy hasn't popped into my head yet. But the hope is that within roughly the 2-year range that you have this buy down, that interest rates will come down as inflation comes down and as we exit this recessionary period, so that you could then refinance into a permanent lower rate than the 7 that you have now.
And so, yes, there is a bit of a gamble there, but like Shannon said, as long as you can afford the payment at the higher rate, it's an opportunity to take the sting and the expense out of your purchase. Yeah. And that's pretty huge.
It's a bonus. It's a super cool bonus, and it's a tool you could use with which to get yourself into a home to propel your long-term strategy going forward.
And the other thing that I think is worth pointing out is that particularly here in Portland, where we are, or if you're in a big city that's a popular vacation and travel destination for people, there are things you can make money off of your property as a homeowner that you can't make off of it as a renter. You know, you can rent a spare bedroom in your house on Airbnb for $45 a night. So you need to also look at your missed opportunity for income stream on your house that you wouldn't have if you were a renter.
That is correct.
And in times like this, like for example, my husband and I are converting our garage into an ADU right now, with the anticipation that we're going to probably be able to pay our mortgage off of the income from that ADU, which is pretty cool. So no matter what happens, if we suffer a job loss, if the market, if I don't have a sale 1 month or something like that, I'm still going to be able to pay my bills. And you can't, and if you are buying a home, especially if you're like a young couple or a single person buying your first place, you can rent a room to a roommate. And rents are going up, so that really plays in your favor. That can offset your mortgage.
Mm-hmm.
We'll do an episode later of different ways that you can make money off of your property. But you can rent out your parking spot to people if you're in a high volume business area where there's not a lot of parking.
Yeah.
If you have,
you always think of the interesting things.
because people don't think about the loss in money making opportunity that their house has for them when they own it, as versus when they're renting.
Yeah.
Because you got to get approval from a landlord to do that, or risk being evicted for not following your contract.
Yeah.
So I think that that's something to also consider, is that, yeah, your mortgage will be higher, but like you can offset that pretty significantly if you're creative and willing to do so. I mean, heck, you can rent your fenced yard out as a dog park for $25 an hour.
I about fell over when she told me about that. As the old person in the room, these things don't always come to my head, and I thought, well, that's amazing.
I think that it's called Sniff Spot, and I think that they should sponsor this podcast. But that, yeah, the point is that like there are opportunity costs that you are missing out on as a renter that you can take advantage of as a homeowner. So consider that when you're considering the higher interest rates and higher mortgage payment as well. And then I think that pretty well.
Well, yeah, that covers a lot of things, right? I think the nice cap on it is I'm waiting for the market to crash. And then I'm going to buy. And the answer is...
You're not going to know it's crashed till you missed it. We don't, in all the past market crashes that we're looking at historically that people are basing this saying off of, I'm waiting for the market to crash. I bet you didn't know that it crashed until after it happened.
Till the news told you.
You
didn't see it coming.
And once the news is telling you, it's too late. Things are coming back up. Yeah. We're talking about how we recover from the crash. So you have to take advantage. You have to look financially at where you're at now. Can I afford this? Is it worth it to me to lock my payment? Is it worth it to me to have my own space? Is it worth it to me to be able to write off costs? Is it worth it to me to be able to change my environment to what I want it to be, rather than having to find everything that's like peel and stick for your apartment? Is it worth it to me to have pets and be able to have friends over if they need a place to crash? These are all factors that you need to consider when you're looking at buying your home. And if you're an investor, you have to look at, is it worth it to me to buy while things are pretty low so that I can gain equity on the long-term hold of this property? Because that's where the most money is in that long game.
That's why we do 30-year mortgages.
Because it is a long period of time, but they usually pay off pretty significantly.
Everybody has their own investing strategy, but a good majority of them are buy and hold. You are looking for long-term appreciation, mortgage paydown, and cash flow during those times. Yeah. And the ups and downs of the market even themselves out over time and generally make you come out okay in the end.
And I think that, you have to ask those questions to yourself and see what's worth it for you. And if the answer is, you know what, I would like to lock in my payments and do all of those things, then buy your house, get a good realtor, get a good lender, and get your plan in place so that you can be successful with your purchase. Because now is the time to buy.
There we go. So call Saoirse if you're in town.
If you're in Portland, call me. Call me if you're not. I know people all over the place and I'd be glad to give you a referral.
There you go.
Thank you for listening to our podcast as always. Check us out online at theladdercast.com and send us a message if there's anything you want us to talk about.
Thanks for being here.